Hey guys, it's Steven here. In this video, I will rank all the different types of index funds on a tier list to help you make the best picks for your index fund portfolio. Index funds are a low cost, easy and efficient way to safely invest. Whether you start with $100, $1,000 or $10,000, if you have any spare cash sitting around, you can put your money to work for you. To have everyone on the same page, an index fund is a pooled investment vehicle that gives you an instant slice of ownership in hundreds of thousands of companies in one purchase. Not everyone has the time or expertise to research individual stocks, so investing in index funds gives you the benefit of strong performance, beating out 90% of actively managed funds, diversification essential to spreading the risk of your portfolio, and tax efficiency, as index funds tend to have significantly lower turnover than actively managed funds. With thousands of index funds available across all sorts of providers such as Vanguard, Fidelity, Schwab, and other brokerages, you have many choices. This tier list will include domestic equity index funds ranging from small cap to large cap, international index funds, fixed income funds, and at the end, some very interesting specialty sector funds that every index fund investor should be aware of. Some of these funds have generated up to 20% per year over the past 5 to 10 years, which is incredible. You usually will not expect that type of return. Typically for an index fund investor, you would expect an average return of about 10% per year. It will not be a positive return every year, as there will be ups and downs in the market cycles, but it is an upward trend rise over time. On average, index fund investing will double your money about every 7 to 8 years. If you're interested in specific index funds for your brokerage of choice, whether you used Vanguard, Fidelity, or Schwab, I will leave links to those in the comments below. In this video, regardless of what brokerage you use, I will break down the best index funds that are available for you. This tier list can be a great guide for beginners starting their index fund portfolio and long-term investors interested in index funds. Index funds are a big part of my portfolio that I use to achieve financial independence. Over the past decade, I've researched and analyzed each type of index fund for their historical performance, portfolio holdings, risk profile, low expense ratio, less than 0.2% is a key to keeping down your costs, and most importantly, potential for future returns. This tier list is my personal opinion. Feel free to leave comments down below where you think a certain type of index fund belongs on the tier list. What is the index fund tier list? As we go through the index funds today, the S tier funds are the best of the best. These are the greatest standalone funds that will produce excellent results for long-term investors. If you were starting an index fund portfolio, these are the funds that you would choose first. A tier funds are very similar to S tier funds, but they may be lacking one component or another when compared with S tier funds. It could be higher volatility with the funds you select, or you might be less diversified depending on what you choose. However, if you're making an index fund portfolio or choosing multiple funds, then A tier funds are definitely worth considering. B tier funds are not going to produce as great of a long-term performance as S or A tier funds, but they can be utilized in specific circumstances. Whether you're looking for something in particular, if it's less volatility, or you just want to have safer returns, potentially then you can consider some of the B tier funds. C tier funds will produce notably significantly less returns than any of the other funds in a higher tier. Funds here are for people who are willing to potentially take a little bit of a chance on things such as expecting greater future performance. Funds have had weaker performance, at least when compared to the funds above, or reduce volatility as you get closer to your target retirement age. D tier funds are funds that are not worth considering if you are making your first few funds for your index fund portfolio. There are much better choices than these, as this tier severely underperforms when it comes to producing long-term results. Funds in the C tier possess some of the qualities of D tier funds while producing better returns. Let's jump right into it. First, we have the large cap index funds, which will be some of our top ranked index funds on the tier list. Large cap index funds include absolute staples for any index fund portfolio, such as an S&P 500 index fund. In an S&P 500 index fund, you're getting exposure to all the big companies that make up about 75 to 80% of the total market. Top 10 holdings include Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, and Nvidia. All large, stable companies. Examples of S&P 500 index funds include the following index funds from the respective brokerages. So no matter which brokerage you use or decide to use, you have access to fantastic S&P 500 index funds. Vanguard 500 Index Fund Admiral Shares, VFIAX. Fidelity 500 Index Fund, FXAIX. Schwab S&P 500 Index Fund, SWPPX. SPDR S&P 500 Index Fund, SPY. S&P 500 index funds belong on the S tier. Next, for total market index funds, they seek to provide investment results that correspond to the total return of a broad range of US stocks. You're essentially mimicking the growth in buying a piece of every company in the United States and investing in the future growth of the US economy. The top 10 holdings are the same as seen in the S&P 500 index funds, but with a lower percentage allocation in its top 10 holdings and spread out over thousands of companies instead of 500 companies. Examples of total market index funds include the following index funds from the respective brokerages. Vanguard Total Market Stock Market Index Fund, VTSAX. Fidelity Zero Total Market Index Fund, FZROX. Schwab Total Market Index Fund, SWTSX. Total market index funds go into the S tier. Other large cap index funds include large cap blend, value, and growth index funds. Which one you prefer depends on if you're more of an investor in growth stocks or value stocks. Growth stocks are companies which are considered to have a good chance for considerable expansion in the future, either because they have a product or lines of products are expected to sell well, or because they are predicted to gain an edge over their competitors in the future. Growth companies could still be investing heavily in research and development for future expansion. Or if as an investor you prefer value stocks, which are usually larger, more well-established companies that are trading below the price that analysts feel the stock is worth, depending upon the financial ratio or benchmark that is being compared to. These are typically companies that have reached the top of their business cycle, versus growth companies that are just ramping up in their business cycle. Value stocks are cash cows, generating profits and could be paying dividends. If you would like a mix of both value and growth, large cap blend is the way to go. Regardless, all three are fantastic choices and I have all of them in the S tier. Examples of large cap blend, value, and growth include the following index funds from the respective brokerages. Vanguard Large Cap Index Fund Admiral Shares, VLCAX. Vanguard Value Index Fund Admiral Shares, VVIAX. Vanguard Growth Index Fund Admiral Shares, VIGAX. Schwab Large Cap Growth Index Fund, SWLGX. Schwab US Large Cap Value Index Fund, SWLVX. Fidelity Zero Large Cap Index Fund, FNLIX. Fidelity Large Cap Growth Index Fund, FSPGX. Fidelity Large Cap Value Index Fund, FLCOX. Next up, we have the Mid Cap and Small Cap Index Funds. Overall, mid-cap funds have higher volatility than large-cap funds, and small-cap funds have the greatest volatility when compared to either mid or larger-cap funds. Typically, small-cap funds have a market cap between $300 million to $2 billion, and mid-cap funds have a market cap between $2 billion to $10 billion. Both small-cap and mid-cap index funds have the potential for greater future returns than large-cap funds, but the trade-off is in the higher volatility. Investors can also choose between growth versus value small and mid-cap funds. I place the mid and small cap funds into the A tier, but if you can stomach the volatility, these funds are easily also S tier funds. However, if you were to select only one index fund, I would have these ranked below large cap S tier funds. If you're selecting multiple funds for your index fund portfolio, these mid-cap and small-cap index funds are S-tier funds and also make up a good portion of my personal portfolio. Examples of mid and small-cap funds include the following from the respective brokerages. Vanguard Mid-Cap Index Fund Admiral Shares, VIMAX. Vanguard Small-Cap Index Fund Admiral Shares, VSMAX. Fidelity Mid Cap Index Fund FSMDX, Fidelity Small Cap Index Fund FSSNX, Schwab US Mid Cap Index Fund SWMCX, Schwab Small Cap Index Fund SWSSX. Next, we get to international index funds. While I have tremendous faith in the growth of US companies, many countries around the world have fantastic companies. This investment seeks to track the performance of a benchmark index that measures the total return of large, publicly traded, non-US companies from countries with developed equity markets out of the United States. Over the next 25 to 30 years, I do not see international equities outperforming US companies. The US is the leader in innovation for the foreseeable future. International equities also produce less returns than domestic equities historically. The international index funds go into the B tier. If you think international companies will surpass American companies in technology and innovation, you can have them in a higher tier, but I don't think that will be the case for a while. Examples of international stock market index funds include the following from the respective brokerages. Vanguard Total International Stock Market Index Fund Admiral Shares VTIAX, Fidelity Zero International Index Fund FZILX, Schwab International Index Fund SWISX. When it comes to international index funds, there's also a category for emerging markets index funds. These funds invest in stocks of companies located in emerging markets around the world, such as Brazil, Russia, India, and China. Stocks of companies in emerging markets tend to be more volatile than those in developed countries, which could imply the potential for greater long-term returns. But I do not see this in the foreseeable future. Historically, these funds have produced underwhelming results, which I won't dive into here, but can be due to a variety of factors ranging from political instability to developing a skilled workforce. Long-term risk-tolerant investors who want to diversify their international portfolio may wish to consider these type of funds. Emerging markets index funds go into the C tier. Examples of emerging markets index funds include the following from the respective brokerages. Vanguard Emerging Markets Stock Market Index Fund Admiral Shares VEMAX, Fidelity Emerging Markets Index Fund FPADX, Schwab Fundamental Emerging Markets Large Cap Index Fund FSENX. Beware of a higher expense ratio of 0.39%. Next, we have the fixed income index funds. Fixed income have produced significantly less returns than equity index funds historically, and are better for investors with a shorter time horizon. Investors getting closer to their target retirement date may have a higher percentage in fixed income index funds. Or if you want to reduce the volatility of your overall portfolio, you can consider adding a bond index fund. But as a standalone index fund, they will be severely lagging returns compared to equity funds. I have the fixed income bond index funds in the C tier. Examples include the Vanguard Total Bond Market Index Admiral Shares VBTLX, Schwab US Aggregate Bond Index Fund SWAGX, Fidelity US Bond Index Fund FXNAX. In fixed income, there are also inflation-protected security index funds. These funds are designed to protect investors from the eroding effect of inflation by investing primarily in securities that seek to provide a real return. The fund focuses on investments in inflation-protected bonds that are backed by the full faith and credit of the federal government, and whose principal is adjusted based on inflation. These funds also belong in the C tier. The reason is because if you want to protect yourself against inflation, the choice to pick the best performing funds that give the best returns is the best bet against inflation. Examples of inflation-protected securities index funds include Vanguard Short-Term Inflation-Protected Securities Index Fund Admiral Shares VTAPX, Fidelity Inflation-Protected Bond Index Fund FIPDX, Schwab Treasury Inflation-Protected Security Index Fund SWRSX. Last but not least, we get to a unique group of index funds, the sector index funds. Sector index funds focus on groups of companies that are pursuing the same type of business, like energy, real estate, healthcare, or technology, just to name a few. Investing in a sector ETF allows you to gain exposure to a broad range of companies within this sector, rather than holding a single stock. This can reduce the risk that might be associated with holding a single specific stock such as Apple, Microsoft, Google, or Tesla. For example, if you believe the technology sector will grow dramatically, you can invest in all the tech companies. You can give yourself a concentrated exposure with a technology ETF such as the Vanguard Information Technology ETF VGT or Invesco QQQ, which are two of the best performing large cap growth funds in the past decade. Fidelity also has Fidelity MSCI Information Technology Index ETF. Another sector fund is the Real Estate Investment Trust, which allows us to add real estate exposure to our portfolio without the headaches that come with managing physical real estate, and generally come with a dividend yield. These funds include companies that develop and manage real estate properties including apartments, factories, healthcare, hotels, industrial, mortgage, office, and shopping centers. While the returns from real estate investment trusts do not appear to be as great as the equity index funds, they provide that real estate exposure that makes your portfolio more resilient through all economic cycles. Examples of real estate investment trusts include Vanguard Real Estate ETF VNQ, Fidelity Real Estate Index Fund FSRNX, Schwab US Real Estate Investment Trust ETF SCHH. Different sector funds can fall into any of the tiers. I personally have the technology sector index funds in tier S and the real estate investment trust in tier A. There are other sector funds that I have not discussed, and specialty index funds are a mix of stocks and bonds. One bonus type of index fund I would like to mention is that if you like to keep it as simple as possible, you can choose a target 20 star year index fund, with the stars being the target year for retirement, like the SWYNS Schwab Target 2060 Index Fund. 2060, the year that you expect or want to retire at an expense ratio of 0.13%. Slightly higher than the other index funds mentioned earlier, but they set the entire asset allocation for you. For example, in the SWYNX 2060, the target index funds will also adjust the allocation from stocks to bonds as you get closer to your target date. These are available on Vanguard and Fidelity as well. There you have it. You have a tier list of index funds that meet key criteria for selecting index funds. Investing does not have to be hard. You can get started investing whether you start with $100, $1,000, or $10,000. If any spare cash sitting around, you can put your money to work for you. Let's take a final look at the index fund tier list. How do you think I did with the tier list? Hope you guys found this video helpful. This tier list is a great starting point for both beginners and long-term investors interested in index funds. There's such a wide selection of great index funds for your index fund portfolio. If you disagree with any of the rankings, feel a particular index fund should be ranked higher or lower, feel free to leave any comments down below. Be sure to like this video to help the YouTube algorithm, especially if you enjoyed this content. Subscribe and hit the notification bell for more videos delivered to you. Have a good one.